Good evening, everyone. Thank you for joining us for this Decoding Union Budget webinar. My name is Manish Garg and I'm SVP Wealth Management for HSBC India. For this session, joining me is Prashant Jain, Executive Director and Chief Investment Officer of HDFC Asset Management, to discuss more about budget. Prashant comes with a rich experience of over 28 years in investment management. While Prashant oversees asset management of over 4.5 lakh crores, he personally also manages equity assets of more than 80,000 crores. He has a distinction of having managed the fund continuously for nearly 26 years with a CAGR of greater than 18%. He has worked with SBI Mutual Fund, Zurich Mutual Fund in past in his capacities. Uh, just before we start, little housekeeping. Before we get started, please type in your questions in the box below. We will be taking the questions after Prashant has shared his views. Without much ado, I will hand over to Prashant for his views on the budget. Prashant, over to you.
Thank you, Manish, and a very good afternoon to all of you, friends. And it's a pleasure speaking with you. And I will share some thoughts around the budget, the economy, and also the markets, and happy to answer any questions or have any discussions thereof. You must have noticed that this was a very small budget speech relatively compared to the last budgets. I think that's a very welcome development because what it signals is continuity of policies, continuity or stability in taxation. So I think India is moving in the right direction, and there's not much to honestly discuss in this budget. But as I said, it was there's hardly any changes made. Let me try and share with you what are the key objectives on which the current government seems to be working. So I think the first and foremost objective is to revive the capital expenditure cycle in India. As we know, the capex cycle has been quite weak, and in the last decade, actually post Lehman, we have had 10 years of weak capex. There have been a series of developments which have resulted in this. I think the government is trying to reverse that, and for the second or third year running, I think for the second year running, the allocation towards capital expenditure has gone up meaningfully, despite not such a good fiscal position. I think there is clear intent there, and if you read the subsequent interviews of the various secretaries, they are saying we want to crowd in investments. And I mean, the message is that once you start the cycle, positivity, private sector will also join in. I think the environment is quite conducive, even for a revival of the private capex. Why? Because we are seeing, despite concerns around rising interest rates globally, liquidity and interest rates continue to be very supportive. And we are seeing very significant capital inflows, not just on FII and PE formats, but also, not just in FII and FDI, but also in PE formats, which clearly have led to the evolution of the startups in India. The corporate leverage in India is now at a 10-year low, and we have seen a fairly broad-based revival in corporate profitability across manufacturing. Whether it is paper, sugar, cement, metals, chemicals, textiles, fairly broad-based revival in profitability. So I think the environment is quite conducive even for the private sector capex revival. I think the government continues to emphasize this, and they have taken the PLI initiative. We have made good progress on that, and I think this revival of infra and private capex has the potential to accelerate India's GDP growth in the current decade. I think the second key initiative which the government is working on is to encourage manufacturing in India, Atmanirbhar Bharat or Make in India. I think we are faced with a very conducive environment to capitalize on this because our wages are now, manufacturing wages are half of China. This was not the case 10 years back. China has grown, per capita incomes have grown. So India finds itself very comparatively placed. The second reason is what happened in COVID and the subsequent lockdown. It caused considerable disruption to the supply chain in China. Since the world was and continues to be over dependent on the Chinese manufacturing supply chain, this disruption has led to a realization that we need to de-risk. There is a keen desire to develop an alternate source, and that is where India comes in. I think India ticks all the boxes. It has entrepreneurs, it has skills, it has natural resources, it has a very supportive government, and above all, it has a very large domestic market, which almost all of our other Asian peers do not have. And that gives us a significant comparative advantage. The PLI scheme is a big initiative in that direction. The government is also supporting through various tariff and non-tariff based barriers. Even in this budget, there was a mention that the indigenous defense equipment procurement is likely to go up from 58% to 68%. I think the government continues to take initiatives around or policy steps around this. The third objective, I think, which has been largely met, is stability in taxation and ease of administration of the taxes. I think we have made decent progress in that area. GST has completely stabilized. There were hardly any tax changes in this budget. And the FM said that we are looking forward, we are planning ahead, not just for a few years, but even for 25 years. So I think we look forward to continued stability in tax policies, and that is extremely conducive for bringing in investment. I think the fourth objective is to improve the digital ecosystem in India, along with faster adoption of green technologies, including EVs. I think we continue to make progress in that direction, whether it's about connecting all the post offices or digital delivery of various services which we have experienced over the last few years, or it is about a new healthcare. Some initiatives are being planned. I think we are very keen to move to the new digital world as quickly as possible, and the government is also very keen for a faster adoption of electric vehicles. And I think policies continue to be supportive around that. The fifth and final initiative, I think, or key objective is fiscal consolidation. As we are aware, prior to COVID, India had managed to reduce fiscal deficits quite meaningfully. But COVID, I think, has led to a sharp spike in fiscal deficits. I think that was the right strategy at that point of time. But clearly now, as things normalize, we need to bring down the fiscal deficits, because over time, high fiscal deficits lead to serious imbalances in the economy with negative long-term consequences. This year, the fiscal deficit is targeted to come down by 0.5%. Some of us probably would have liked to see a bit more. But I think the government is thinking probably that let me revive the economic growth, and then I will bring down the fiscal deficit maybe faster. And also, I think sometime into the future, the global bond markets may be even less supportive than what they are today. So probably you will need to take deeper fiscal cuts few years down the line. So maybe I can use this conducive period outside to use fiscal deficits to maybe revive. I think we should see it in that light, but clearly there is a need to make good progress in this over the next few years. I think the good news is that the revenue assumptions, even last year and this year, are very realistic. So even the sharp reduction in the divestment target, which some people have been concerned about, I think is quite realistic. And they are saying, okay, let me try and do my best, but why keep a very aggressive target? Because it upsets your planning, it upsets the markets. So I think this budget is quite realistic in its assumptions. And therefore, I feel there is a good chance that both the fiscal 22 and fiscal 23 fiscal deficit numbers may turn out to be somewhat lower. Net, I think it was a very good budget, and I hope that we continue with the same trend of giving stable policies in taxation and otherwise. I mean, so that was on the budget. I think as far as the economy is concerned, I think it's safe to say that the outlook of the economy post-COVID is better than it was pre-COVID. And why do I say that? One, clearly, the government is pushing infra spends. Uh, External capital is keen to buy Indian infra assets. I think there is decent supply of capital in that space, and we are seeing good progress in roads, ports, airports, renewable power, urban infrastructure, metros, etc. I think that continues to make good progress and show nice growth. Private capex, as I said, has not yet is not yet growing meaningfully, but I think there are several indicators that suggest that it should revive in the not too distant future. So even the engineering companies are beginning to experience uh, improving order backlogs or order inflows, order inquiries. We are seeing large scale announcements in sectors like uh, cement and steel, especially. So you look at the steel sector, almost all the large majors have announced very large capex plans, ditto for cement. And the PLI scheme, I think, also will bring in significant private investments. Net, I think the private capex cycle should perform better this decade than what it has done in the last decade. Consumption is weaker than what we are used to. Consumption has been the key driver of India's growth last decade. It's a bit weak right now, but I think it should pick up. I mean, hard to say why it is weak. Maybe the country is still partly under lockdowns. There are weekend curfews, night curfews, etc. And the urban services ecosystem is not yet operational, as we all know, whether it is the theaters or the restaurants, airlines, travel, tourism. So while things are opening up, but it has not quite come back to normalcy. So I think that could be probably one of the reasons why consumption is a bit subdued. Fortunately, we are seeing good white collar wage inflation in India after a long time. I'm sure we have read about the significant increases that the IT sector is experiencing. And when one sector does very well, it puts pressure even on the other sectors because talent is clearly fungible, it is mobile across sectors. So I think this white collar wage inflation, which we are seeing in large pockets of the economy, bodes well for consumption coming back. Affordability for homes in India is the best ever. This is driven by stable real estate prices over several years and record low mortgage rates. So the EMI to income ratio is best ever, and this we hope is very supportive of growth in this key sector of housing. When housing grows, it leads to growth in all the ancillary industries. It creates employment for a large number of people. Construction is one of the most labor intensive activities. It leads to demand for cement, steel, paint, ceramics, electrical goods, etc. I think the positive outlook there is also supportive of faster growth. In fact, our chairman, Mr. Parekh, said recently that he is the most positive on housing, most positive ever in his long career. I think the outlook there is also quite reasonable. Coming to exports, Indian exports are actually doing quite well. The 2-year CAGR from pre-COVID days till now is double-digit in dollar terms. India is an acknowledged leader in software services. We have very low competition in that space that continues to do well. In fact, the speed of digital adoption in the world is accelerating the demand for services in the software space. Apart from that, I think we have a good chance of improving our manufacturing share. As we know, China dominates manufacturing. But as I have said a few minutes back, improved competitiveness, supportive government, and a keen desire of the buyers to de-risk has created one of the most conducive environments ever for India to improve its share of manufacturing. This opportunity is so large that it has the potential to accelerate India's GDP growth by 1 to 2% for a few decades. And the government is also, let me just illustrate or give you one example of defense equipment. India has been the world's largest importer of defense equipment for decades. And we are trying to undo that now. So government has banned almost, I think, 300 items of defense equipment from imports because you have local sources available. And this is an ever-growing list. For the first time in India, we are launching or manufacturing India-designed platforms. Up till now, we were component suppliers. LCA is probably the first proper, fully functional, operational combat aircraft that orders have already been placed and delivery should start, I think, in the next 3 to 4 years. There are a few more platforms under development. I think this is one large area where we are trying to improve our manufacturing capabilities. And we are also making serious attempts in the electronic space where we actually, as on date, have no right to win. The government has come out with a fairly large PLI scheme, almost $10 billion, to set up semiconductor fabrication facilities in the country. Net, I think the outlook for exports, manufacturing, led exports and manufacturing for India, both is quite positive. To summarize, I think the outlook for economic growth in the current decade, to my mind, is distinctly superior to what we have done in the last decade. What are the headwinds? I think the headwinds clearly, to my mind, are two. One, we have seen the best of global interest rates. And going forward, we can discuss, debate how higher, what time frame. But clearly, I think interest rates should head higher. Liquidity should reduce over time. So that could have some impact. I think it will have more impact on capital markets than on the economy per se, at least in the foreseeable future, because our foreign exchange reserves are quite decent and our current account deficits are moderate. So while we do need external capital, even if it becomes a little expensive, I don't think it makes a big difference. The second headwind possible is more of a view. I think, see, what has happened is that last 5-7 years, the world has invested less in the energy space, driven by concerns around ESG. So we are seeing a sharp slowdown in investments in oil, in coal, etc. I think the result of that is that we expect, or it's our guess, that supply side will get impacted ahead of demand. The demand will eventually shift, but it may shift slower than the supply side, because you have slowed down investments few years back already. See, even as EVs become a larger part of new vehicle sales, the simple point is that ICE vehicle population will continue to grow for a considerable period of time. Only the new sales composition is shifting, but the population of ICE vehicles will continue to increase at least for the next 5, maybe 10 years. And but you have stopped or you have reduced your investment in the oil space. So that is something which is of worry, that this may lead to higher inflation for a longer period, and that could eventually lead to higher interest rates. We are also seeing in the US record low unemployment numbers, which means wage inflation could be there as well. So when you have energy inflation and wage inflation, I think it is possible that inflation may surprise us on the upside, and that could lead to higher cost of capital globally. Now, coming to the markets, I think uh, uh, when COVID took place, markets had fallen to extremely low levels, and I think what has happened subsequently, uh, in a way, confirms what we have said on many occasions, that the best investment opportunities are found in the most difficult times. So I think as things have normalized, as interest rates have uh, been brought down, uh, the deep undervaluation in the markets has also been reverted. And today we are in a situation that markets have done extremely well. I think one new development of this period was also the rapid growth in retail participation in India in direct equities. I think what has made this possible is coming together of three or four things: extra savings, extra time, digital adoption, and a low market to start off with. And therefore, whatever investments were made, they have resulted in good gains. And that behavior is being reinforced by positive outcomes time and again. I think that's why we are seeing a near doubling of demat accounts in India from 4 crores pre-COVID to 8 crores now, and still growing at a reasonably steady pace. I think this is both positive and some not so positive implications. Positive in the sense equities have become a mainstream asset class. I've spent 20 years of my 3 decade career, 2 decades I've spent in just explaining equities and driving SIPs. There, we don't explain the need, what is SIP, no one asks. We don't speak about SIPs at all. I think that's a very good achievement for the country, that equities have indeed become a mainstream asset class. And what we have also seen, if you look at the last few quarters, FIIs have been heavy sellers. I think they've sold close to maybe 50 not billion dollars, very large number. But the markets have not blinked at all. And that is the good outcome, that the power of the local savings, which was very big, but which was not coming towards equities, is now become a very important force. So much so that in the face of intense FII selling also, the markets just hold their ground. I feel if this sustains, I think it will sustain. It may see some cycles, but by and large, it should sustain. The volatility of Indian markets going forward should be lower than what we have experienced in the past around global events like 9/11, Lehman, tapering, etc. I think that's a good structural long-term development for India. And lower volatility in equities, I think over time will encourage more people to join this or participate in this asset class. Now, what is the downside of this? I mean, I have seen it 3 times in my career, that the majority is seldom right in equities. And the majority opinion actually is more wrong than right. We saw it in 92, saw it in 2000, saw it in 2008. I think this very large participation in equities, both direct, indirect, is created some pockets of excess in the marketplace. We have also seen that the supply of new issues, IPOs, has gone up very sharply. Last year was probably the best year for investment banks in the country. I think it will eventually, these excesses will get corrected, and that may lead to some painful outcomes for some of these investors. But I would look upon that as a learning curve, because I think all of us at some point in our careers, investing or professional careers, have made these mistakes. But I think we should uh, learn from these mistakes. As Warren Buffett has said, that equity markets are a place where those with experience get the money and those with money gain the experience. So I do hope that even if the outcomes are negative for some investors, they will be wiser and they will participate in a more disciplined way in equities going forward. Now, final point, where are we in terms of valuations? I think valuations in India are quite reasonable. They are not cheap. They are not too expensive either. We are trading about 10% above long-term averages. And the growth outlook for economic growth and profit growth is quite positive. Interest rates are likely to go up, but still I think they should remain reasonable. Net, I feel that there is reason to be optimistic on equities over the medium to long term. But I think it is also a time to moderate our return expectations. We should not extrapolate what has happened in the last 2 years. That has been a result of a very low starting point and also a sharp fall in the cost of capital. And these two factors are not relevant anymore. Starting point is not low and cost of capital is going up. So I think these are markets for the long-term investor. These are markets for reasonable expectations. So people may say that, what's a reasonable expectation? I think a reasonable expectation is returns in line with nominal GDP growth. So if you take a 5-year view, let's say the returns, the real GDP growth is 8%. Inflation is between 4 to 6%. So you add up the two, 12 to 14%. I think that would be a reasonable expectation. It would be marginally higher or marginally lower. We should also be prepared for volatility, because as is widely acknowledged now, interest rates outside India will go up. And that could lead to some volatility. We have been used to very low interest rates for 10 years. When this reverses, what kind of volatility it will bring, I really don't know. But I think there is still value in these markets for the patient investor, for the long-term investor. And equity should continue to generate 4 to 6% extra returns over fixed income, as they have done over the last 40 odd years. Manish, let me stop there. I hope that was useful and happy to answer any questions that are.
Yeah, thank you, Prashant, for sharing your views on market, your views on budget. What are the opportunities ahead of us? What are the challenges ahead of us? Thank you for the entire gamut. We will move to Q&A. So we have a lot of questions which are pouring in from the viewers. Once again, I will reiterate that if you have any question, please put in the checkbox which is there below. So we'll move to the first question, Prashant. You touched upon that housing as a sector is doing extremely well at this point, and interest rates are extremely low, but interest rates are expected to go up. We have already moved up on interest rate. 10-year GSEC is almost touched 685 now. So what's your view? Is it still a good time for housing sector? Will it lead to kind of once the interest rate cycle moves up, will it lead to NPAs for the banks? How the banks are geared up to meet that setup?
Manish, what I said is that the affordability of home is the best ever.
Yes.
And that should logically lead to very good growth in housing. And you are right, if interest rates move up, that affordability will move lower to that extent. But as I said, I mean, if you go back 10 years, I mean, or maybe slightly longer, mortgage rates in India used to be in double digits.
Yeah.
So even if 6.5 becomes 7 or 7.5, I would still consider it quite low. And white collar wage inflation is back. So I think even if the mortgage rates go up a bit, it should at least partly get compensated by the higher wage increases that we are experiencing. I think NPAs, uh, we have just come out of an NPA cycle in India. It was a fairly long one, and we are truly and completely out of it now. So the next few years, I don't think we should worry about NPS. And in fact, in housing, in mortgages, we have seldom experienced any NPS. I think it will be quite the way banking works, the way the cycles work. I mean, you get into these NPA cycles once in maybe 8, 10 years. I think we are quite far away from the next such.
Okay. Thank you, Prashant. Prashant, next question is on you touched upon consumption as a consumption is still lower. And this budget does not seem to provide any relief for the taxpayers or in Narega allocations in that sense to spur the consumption. So how do you see that impact on the, especially on the rural consumption and on the middle class consumption without any tax reliefs being provided over there? And then some of the sectors which work on that consumption theme, especially auto, two wheelers, consumer non-discretionary. How do you see your views on these sectors?
So, Manish, uh, the bulk of the country, the tax rates are very moderate. And who is the most impacted in COVID? It is the urban, people who are working in the services sector in urban areas.
Yeah.
And that is not a high paying area. Whether you are in hospitality or in retail, etc. So I think uh, there's not much point in cutting taxes there because the effective tax rates in those income slabs are already extremely low. COVID did not cause pain to the higher income groups. Once again, there is no merit in cutting taxes there. In fact, that group probably has a lot of extra savings. I think the what the government is saying is, look, let me revive the capex cycle. Let me revive, create jobs that will push up wages, and let me try and fix consumption that way instead of giving out cash to people, which will maybe give you a relief short term, but it will not solve the problem. So I think the government, to my mind, I think is doing the right thing. It's okay if consumption remains weak for a few quarters, but I think we need to create jobs because that is the real solution to fixing this. Also, we really don't know, Manish, how much of this impact is due to while the country is opened up, the service areas, service sectors are still not completely open.
Yeah.
I think we will know for sure once life comes back to complete normalcy, maybe 3 to 6 months.
Yeah. Okay. Next question is coming on. A lot of questions actually are coming on. There's a lot of emphasis which was played on EVs, green energy, drone technology, AI, digital platforms. There was a slew of measures which was announced in these sectors. So, how do you see these sectors playing out over next few years? And are we really ready for a big ramp on this space?
Manish, I think we'll make progress in each of these areas. So EVs are coming in, scooters are already there, four wheelers are already there. I think price parity or cost parity is also within grasp. If you have noticed, the taxation ICE vehicles is quite high. Taxation on fossil fuels is also quite high. And that is the government's attempt to bringing a price cost parity faster between EVs and ICE vehicles. I think we will move steadily or maybe rapidly in that direction. I think it will cause a lot of disruption in the incumbent space, and we should be careful when you are investing in incumbents in the ICE, vehicles, and the share, the multiples, and the earnings over time would be impacted in that space. To my mind, there are not many listed opportunities yet to play the EVs. We have to give it some more time. As far as the renewable energy is concerned, I think there are some listed companies that are participating in that space. It is a utility. It earns ROEs of 10-12%, so it will grow, but it's a low ROE business. And even the existing utilities will improve their mix of renewable power over time. Because in renewable power, the key issue is cost of borrowing. So anyone who borrows at the lowest cost is the most competitive. So I think I find that space quite attractive, the utility space. Its valuations are extremely low because of negative connotations of fossil fuels, thermal energy. But I think uh, India's power demand will grow quite rapidly. Our power consumption is a fraction of the world. Also, interestingly, in India, power demand on a daily basis peaks in the evenings between 5 to 9 or 5 to 10 when there is no sun. So I don't think till the time storage is cheap, there is doing away with the fossil. In fact, NTPC just last week announced new thermal plants. I think that's the reality. And the same players, I think, will play a good role in the renewable space as well. So I think that space is looking attractive, but it has utility characteristics even in the renewable space. As far as drones is concerned, I think it's an evolving space and there are startups in that area, but I don't think there are too many listed opportunities in that space.
Thanks, Prashant. Next question is, we are living in quite a high inflationary environment. Globally, also, there is a very high inflation at this point. US perhaps has more inflation than us at this point. So, what do you see the impact of this inflationary environment on precious metals like gold and silver? And silver, especially because there is first time ever the organized sector is coming into silver. We have almost 3 to 4 new fund launches which has happened in silver, and there will be a massive deployment of this money in silver.
See, to be honest, I'm not done much work on silver, so let me maybe I can come back to you after a few weeks or months.
Yeah.
Gold, I feel that see the real prices of gold adjusted for inflation are quite high already. And there is a slide on this in our recently released yearbook. I think, therefore, high inflation in the future may not necessarily lead to higher gold prices because gold prices in real terms are already quite high. On the other hand, interest rates are also likely to go up. When interest rates go up, I feel that it would be negative for gold because when interest rates are zero, both households and institutions put some money in gold. But when there is reasonable return by way of interest rates, probably it becomes more attractive versus gold. So I think one can invest in gold as Indians have always done. It's a good insurance. It's a good hedge against macro turmoil in the macroeconomy in India, outside India. But I think I would be cautious on my returns assumption or estimate on gold. As far as silver is concerned, as I said, I really don't know.
Okay, thanks, Prashant. No problem. Prashant, next question which a lot of people are asking us is, what is government trying to do with cryptocurrencies? So while they have not legalized it, they are not illegalized it, they have put a tax on it. They are saying RBI will also now issue cryptocurrency or digital currency, so to say, in form of from blockchain technology. So what's our views on this space?
See, I think digital currency is a electronic version of the rupee. It's like, I mean, maybe an akin to a debit card versus cash. I think digital currency is something quite, instead of carrying a share certificate, you are carrying a share certificate in a demat form. It is something like that.
Right.
As far as cryptos are concerned, I mean, I don't want to say much, but I have read the interviews today, and they are saying that taxing it does not mean giving it legality. I mean, let us just go by that. And I, for one, believe that one should, I mean, I don't understand that space well. Whatever little I understand, I feel it is on a very weak wicket, this cryptocurrencies, and one should simply stay away from.
Thanks, Prashant. Prashant, next question would be on the capex. So there is a lot of thrust which is put upon capex over next few years, and especially for the sectors like road, railways, communication, defense. But there is very interestingly, they have put onus on public-private partnership for most other sectors. So how do you see this public-private partnership model evolving over next few years?
Yeah, I think, I mean, in a way, the PLI scheme is a public-private partnership because the government is giving you subsidies or even in various projects, the government is giving grants. For example, in the lay this transmission project, they are giving you grants. I think that's the way of looking at that. Uh, but I would say that government is stepping in where private capital is still not there. And the moment there is access to private capital in a particular space, the government withdraws. The government has clearly said that they want to reduce their presence in the non-core, non-strategic areas. And that is where the whole strategic divestment program comes in. So, I mean, in railways, government is inviting companies to develop stations, to own trains, which has not taken off, to own airports, to own ports, to own, distribution franchisees in various areas. So government is clearly encouraging private investments across the board, and we are seeing reasonable progress in different areas.
Mm, yeah. And Prashant, coming on to the fiscal deficit, government obviously had given a roadmap that by 2025 they will like to reduce it to about 4.5%. But bond market seems to have not liked it so much. Bonds have rallied post that comments. So views on bond markets?
I think there our views, Manish, have been very consistent. If you have been saying for last 2 years, we have been saying that interest rates. There is not much merit in being at the long end. There is very little to be gained, and I think our view stays the same. Of course, given the increase in the slope of the yield curve, it is now almost I think 3%. I think the yield curve is very steep. So my guess would be that the short end of the yield curve should move up a lot more than the long end. I mean, philosophically, the way I have approached this is that we should not see in fixed income, uh, the rewards for what risk we take are quite small. And if you are wrong, the pain can be equally meaningful or even larger at times if you run into a great situation.
Yeah.
Whereas in equities, the risk reduces over time and the rewards are quite high. So I always feel that philosophically one should minimize or not take additional risk on the fixed income side. Rather, whatever is your risk capital, whatever is your long-term patient capital, you should commit that to equities. It is risky in the short term, but gives you good returns in the meaningful difference it makes to your wealth in the long term. To answer
So
your
if
question in brief, I think one should still be cautious on the fixed income side because we are in the early stages of a reversal of interest rates globally, which have come down for almost 4 decades. In 1983, I think the US Treasuries used to be around 13-14%. And last year we touched, I think, maybe 1% odd. You are just begun the reverse cycle, and we have to wait and see how it progresses.
Yeah. So what would you suggest for a low risk investor to invest in? So what kind of funds they should look at from a debt market side?
I think you could look at the short-term plans, the medium-term plans, funds with 1 to 3 year durations. That over 1 2 years, even if interest rates go up, the impact is it comes back to you by way of the higher accruals.
Hmm.
I
Okay.
would avoid the long duration funds.
Okay. Got it. Thanks. Next, there are a lot of questions on how does the Fed this current hawkish views and their views on taper in will roil us, because a lot of people believe that there's and as you rightly pointed out as well, that the amount of money which is outflown from equities by FPIs is humongous, and as interest rates as they go up in US, how do you see that impact on the emerging market equities and India in specific?
See, I think the FI selling that has taken place, it could be in anticipation of this rise in interest rates.
Yeah.
So it's hard to guess how much more is yet to come. That is point number one.
Right.
Point number two, the developments outside India have not had an impact on medium to long term returns of EM markets. The correlation between global events and Indian markets is there for very small periods of time. In fact, over long periods, there is very little correlation between US and Indian markets. The correlation of Indian markets is essentially with the Indian economy. All of 90s, the developed markets did extremely well. Indian markets were flat. 2001 to the decade of 2001 to 10, India did extremely well. US markets did not do comparatively well at all. The last decade, if you see the developed markets, the US markets have done far better than the local markets. I think the point here is very simple. Your long-term returns are not correlated at all. But yes, there could, as I said, there could be volatility induced by global bond markets, global equity market corrections. To my mind, we should use these opportunities to increase exposure to Indian stocks, because the best entry points to Indian markets have been provided when there were adverse developments outside, whether it was 9/11, whether it was Lehman, whether it was tapering, or whether it was COVID.
Absolutely. Okay. Next one is on the proposed SEZ Act, because that do you think that will boost the XCZ-led exports, which has fallen very sharply over last couple of years?
So, Manish, I am not on top of this. Maybe I
Okay.
could come back to you on this.
No problem. And Prashant, coming on to the sectors, which do you think that after this budget and quite clearly are the clear winners for next 5 years? What would be your sense on that?
Manish, I think there, at least from my, business perspective, the focus is entirely on capital expenditure, on infra capex, on hopeful revival on private capex, on manufacturing. The credit cycle in India is behind us. I think the capex cycle is in front of us. So hopefully, sometime in the near future, the credit demand in India, which has been weak, around 8% odd, will pick up. Bank balance sheets are clean, liquidity is good, capital adequacy is good. So if credit growth picks up, I think it will be quite positive for banks as well. In summary, what I am saying, banks plus capital spending linked businesses, I think should do better in this.
Okay. And given that you touched upon that disinvestment targets have been reduced quite dramatically, So two questions on that. One obviously is that you, as you rightly pointed out, government has tried to play it realistically and conservatively because they have not been able to divest much in last couple of years. But first, what's your view on LIC IPO? Do you think that it will come in this financial year itself to fund that fiscal deficit gap which they have right now? Second, what's your view on overall PSU as a segment, both PSU banks and energy companies, to be specific?
Manish, I think Deepam Secretary has said today or yesterday in an interview that he expects, he is hopeful that LIC will come to the markets this year itself. And the prospectus is being filed in a week or so. That's on LIC. As far as PSUs are concerned, I think there are a lot of not myths, I would say misconceptions about PSUs. Not all PSUs are bad. Not all private companies are good to my mind. We have to be careful whether we are buying in public or private sector. We must buy businesses that are comparative, sustainable, and available at a reasonable value. And let me give you some examples. So, if you buy a government company in the service industry, it is unlikely to be good. So, we have never bought a telecom company or a airline company in only government. Because in service industry, the private sector does much better. But when you look at core areas of the economy, when you look at, let's say, the mining sector, where PSUs have an advantage of having, access to mines over a very long period of time. When you look at the capex heavy sectors like power or oil retailing has been open to private sector for 2 decades. But you look at their market shares today, it is still very small. You look at the private sector company, the power companies, there have been many failures in the private sector in power space. It's a long list. But PSUs have done by and large well. So I think we have to pick and choose from both. In some areas, PSUs have an advantage. In many areas, they don't. We have to be careful with that. I think two more things why PSUs did not do well in the past and why they are beginning to do better now. A few years back, we had, sold down stakes through the ETFs route. That I think was a wrong instrument, and that has done considerable damage to the valuations of these companies. Fortunately, that has been discontinued almost 2 years back, which I think is leading to better performance from these companies. The second is most of the PSUs are in the core areas of the economy. You will not find PSUs in consumer space, in IT space, in pharma space. Last many years, the core economy was not doing well. Capex was weak and PS were there. And that was one reason PSUs as a group were not doing well. The main focus was on IT, pharma, consumer in the marketplace, where they are not present. But of late, as you see the core sectors doing well, NPAs have come down, commodity prices have gone up, Capex is recovering. As these areas are doing well, PSUs are also doing better, both in the marketplace as well, stock markets. I feel if you buy PSUs that are sustainable and which are reasonably valued, over time they tend to do well. I think this divestment program could also be a good trigger. So far, we have seen divestment of unlisted companies. We are yet to see divestment of a listed company. If that happens, I think it will be an important trigger for other PSUs as well that may be sold at some point in the.
So, and specifically on PSU banks, how do you see their balance sheet now, and how do you see their valuations now?
See, again, Manish, two things here. See, the large banks are well placed, both in private and public sector. If you look at the private sector, also the smaller banks have not done well. So many are actually have been in deep pain. Some are still in pain. Many small banks are also losing share. I think generally the way digital is getting adopted, the environment favors the larger banks in public and private sector. But answering your question specifically, I think the capital adequacy ratios are good. NPA cycle is behind us. I think we should not worry about stability for these banks. The but as regards competitiveness, as regards investments, I would clearly focus favor the largest of these.
Thank you, Prashant. Just cognizant of time, we will take one last question which has come in. Views on, since the wholesale inflation is almost in double digits now consistently, what's your view on agri commodities, fertilizers?
I think there is a good deal of mean reversion between CPI and WPI. And last year, WPI was higher than CPI. I think this year it will be the other way around. CPI will be higher than WPI. I don't want to take a guess on commodity prices extremely hard because these are global commodities. Many factors influence them, drought in some areas, this, that. So, but generally, I think commodity prices have seen a sharp spike up. I feel in future the returns in that space or price movements in that space should be a lot more subdued.
Thank you, Prashant. So with that, I think we will close the session. Thank you, Prashant, for taking time out today. I'm sure that our viewers have some great takeaways from today's session. Thank you all for joining us today. Continue to take care and stay safe. Thank you, everyone.
Thank you, Manish. Thank you, everyone.
Yeah.